Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
If you can hear me talking, you better believe it's another Saturday morning, and we are back for another weekly market recap. Now, I'm going to tell you straight out of the gate, this is going to be a long one, as you might already see from, the video and the thumbnail. But, it's going to be curious because you see that right now, it's, we already passed 10:30 in the morning, but the clock is going to be different. It's going to be looking like I'm traveling back in time. The reason is because I wasn't so sure to record all the parts of the video, and I decided at the end, you know what, I'm gonna include this one into it. So for those which are sticking to the end, we're gonna have another of those macro discussions, same as a little bit like it was when I was discussing Paul Tudor Jones and his thesis on bonds, or the same as when I was discussing the bonds vigilantes. All right, now for those of you which are gonna stick to the end, of course, which I'm not betting there will be many, but yeah, so it will be. So before getting into it, let's have a brief look to the economic calendar, because this week finally we had a few data points released. Oh, of course, we have inflation, because no matter the shutdown, finally someone decided to step back and to publish a few data here. So the core inflation rate, it came in at 3%, down from 3.1 of the previous read. So not a lot of big of a change in there. CPI, so the headline CPI came in at 2.9. No, at 3%, I guess, slightly up from 3.9. Of course, people will tell you it's because energy jumped. Energy, mainly oil, it jumped like this week. But the CPI, it's for September. So, obviously, no, it's not energy. There's always a little bit of a lag, right? So, no, it's not. At the end of the day, again, we are still in this range. I'm not really saying anything which is particularly different or would suggest something critically different coming in over the next few weeks or months. I think, again, maybe, we just got to the point where 3% is the new 2. Maybe, I don't know. I'm still thinking we have the potential to go down a bit more, but we'll see about that. Now, the Michigan consumer sentiment came in, and wow, we are back to the lows of April and May, when we had all the tariffs gate and the tariffs dump. All right, okay. I think, it is, as usual, just a sentiment indication. Take it for what it is. At face value, it would be a negative, because if you think about the consumer sentiment, if it is so low, you could expect a little bit of a slowdown in consumption, therefore aggregate demand going a little bit down, maybe. It doesn't look so much. I mean, for all the shit we have been throwing at the American consumer, well, they have been pretty much resilient. Although, the problem is always, how did they manage to do so? Because, if your savings are all completely depleted now and you're tapping more and more into debt, especially with your credit card, I wouldn't deem it as healthy. But yeah, again, up until the point it works, I guess it works, right? Keep on staying on these Michigan type of survey. The 1-year inflation expectations, as you can see, it came down a little bit. Now, it was already topping out from April, May, when we got the tariffs. Therefore, wow, all these tariffs are going to lead to massive inflation. Then we've seen that a few of them weren't really implemented. And although a few of them were, we didn't see that massive surge in inflation. So maybe even here, expectations for inflation over the next 12 months, it dropped. I mean, it's still around 4.5%, which is higher than where the headline CPI is currently, but at least it's not north than 6%. So it could, again, suggest a little bit of a coming back to reality, right? But we will keep on monitoring it. Then again, for the next 5 years, it looks like people are expecting a higher than normal rate of inflation, which, I mean, it depends how you want to look at that. If you think, like I do, that inflation expectations, same as rates, are just, a consequence of the economic growth, when we should expect a roaring economy in the US. Or, on the contrary, if you do believe that the economy is currently showing a few signs of deterioration and slowdown, you would be brought to believe that all this sentiment, it is really what it is. It's just sentiment. And sooner or later, it will flip back to reflect economic fundamentals. So we'll see about that. It's not something that you can't really judge. Like, I mean, can you judge sentiment, right? It's like what people feel, and it's how they answer to the survey. Now, the break-evens had a little bit of a jump this week, as you can see. Might have been for the CPI release, or it might have been, again, we will discuss it when we will be looking at oil. It might be for a few announcements which were made throughout the week. I guess it's too early to tell, but we'll see about it, all right? Trueflation, as for the core PCE, it's printing at 2.4. As for CPI, 2.30, which is, it's still on the high side of this range that we have been looking at since June. And of course, it's obviously lower than the headline CPI. GDP now, it's still printing a 3.9. Didn't update from since last week, basically. FedWatch is showing you a 98% chance of cuts at the next meeting. And let's, for the sake of it, let's briefly check the December one, which is printing a 91% probability of another 25 basis points cut. All right, so we are still, the market is still on the go for more cuts into the future, right? Quickly, credit spreads kind of down. We had that little bit of a spike, and then they are coming back down. And listen, we are still at historically low levels. So if you zoom out enough, look at that, right? So again, the risk is that at a point, there is no more room to the downside to go, so they will have to go to the upside necessarily, but we'll see. We will need to wait for a credit-related event in order to judge them to the upside, right? Although, I think, again, it's not something that I would deem as substantially dangerous or impactful at the current moment in time, but maybe a little bit of a canary in the coal mine. I know it's just related to auto loans for now, but we keep on looking at these, how do they call them now? Because they can't call them shadow banks. So they're calling them an FDI, not fiduciary depository institutions, something like it. Just not to call it shadow banks, right? But we are seeing a lot of them actually going bust. Like this week, there was another, which was implied with Karl Marx, I saw. I don't know. It's like, the third or the fourth subprime auto loans entity going bust in what? 2-3 weeks? I don't know. Let's just hope it doesn't escalate, right? But with that being said, let's jump into the charts, and then we will go ahead with the, kind of the hot topic for the week, right? Let's have a look at these charts, although I think maybe just a few of them will be really interesting. The others will be kind of dull because they didn't move a lot. So looking at the DXY in here, you see that we kind of extended that bounce we initiated last Friday. But when we got into the middle of the week, the market just started to go sideways like this. I think, in a way, you could retain your slightly bullish bias on this one for, for the technicals and the posture of the market at the current moment in time, but also for the fundamental news we have been discussing for like the last 2 months, more or less. So again, at first glance, I would say there is still a possibility to push toward these highs once again, but currencies are like these. They might go nowhere for weeks sometimes, and then you have a repricing following an event or an announcement by, I don't know, major central banks, or it could be one really strong government, really important government around the globe. So, I wouldn't read a lot into it for now, if not maintaining the bias that I had before. Even if we look at the others, like you see the euro, it kept on coming down a little bit after the bounce off of this region, which, as we've seen, was relevant in the past. But it's kind of stuck now in between these fractal to the upside. We reacted to this point of release right here. We came back down, testing the old level and this range where we reaccumulated before pushing to the highs. And now we are kind of stuck in this region. So, I mean, in my view, that there's not a lot to read into it. If not, up until the point we either break out to the upside and resuming the potential upside, or we break down. So I don't really have a lot to say. Same for the pound, although as we've seen, the pound has been a bit weaker relative to the euro in this period of trading. But the assessment would be kind of the same, like up until the point we don't break this low right here, or we start to break highs, and the most recent one would be this one in here, right? Getting back to the end of September. I don't have a lot of bias one way or the other. If not, again, the one derived by my assessment of the DXY for now. So we'll see about that. The yen, it's really weak relative to the rest, and currently sitting at and around 150, almost 153. So not cool for the yen, I would say. Is it a death sentence? I don't honestly know. I think I've always been particularly vocal in saying that, the Japanese are facing a very difficult dilemma now. Are they going to save the bond market, therefore the JGB market, or are they going to save the currency? I think in these cases, as I stated in the past, I think there is a video which is now maybe 2 years old, or something like it. I always said that in these circumstances, a government always pick the bond market rather than the currency. So who's going to pay the price at the end of the day? Well, citizens, as usual, right? You need to maintain the status quo and preserve the establishment at the expenses of the citizens. Because, think about it for a minute. Like, if we zoom out on a weekly time frame, right? So this is the yen relative to the dollar, getting back to, 2011, 2012, right? So it was at 80, more or less 77, something like it. And now it's 150, more or less. I know it's a very long time frame. It's a very large time frame. But, over the last 15 years, more or less, they just lost, 50% of their purchasing power. And you could say, well, but this is just the yen against the dollar. It doesn't really tell the whole story about the yen itself. Well, maybe it does, right? Because think about Japan. It's an economy which it's importing the majority of the inputs that it needs in order to produce stuff, to produce services, to produce the technological things they do yet. So those inputs, if you think about minerals, if you think about energy, are all priced in what? Like if they want to acquire oil or gas or, copper, lithium, steel, whatever, it's all priced in dollar. So if your currency is losing a lot against the dollar, and then when you have to buy oil on the open market, you have to swap your yen for dollars and then buying the oil. So you're taking a haircut, a substantial haircut there. So it's not surprising that Japan is facing a very difficult situation for now. But again, don't want to make it a discussion about Japan, so let's move on. Now, Canadian dollar, still kind of the same, is still in this range. It looks like we want to hold these lows for now. They were swept just a little bit, but are we currently above or below it? Yeah, flirting with it. Not really made up his mind yet. We'll see. It's, again, one of the weaker of the pack among these six, so for sure I wouldn't be so enthusiastic over it, right? Instead, what you could be still enthusiastic over, it's the Swiss franc, which again, still showing a very bullish posture for now. Yeah, grinding, not really moving sharply like it was in here, but remember that in here it was April, so basically the tariffs announcements and all the rest. But among all of these, surely the Swiss franc, it's still the best for now. Now let's move on quickly to the others. But again, not a lot really. Like the Chinese yuan in here has been stuck in this area for like what? Since the end of September, so basically a month. Same for the South African rand. A little bit of volatility in the Brazilian real, but we are still at the same levels we were basically end of September, but really this region was sensitive getting back to August and even prior to it. So I don't know. I'm not really getting a lot from foreign currencies at the moment. What's that? The Australian dollar, again, it's been stuck in this range for ages now. It had this breakout attempt and it was quickly faded and it got back into the core, into the bulk of the volumes. And again, it's just going sideways in this range since June or even May, if you believe that. The Russian ruble, we got that rejection we were talking about last week, and it looks like it came back up to the upside. I think, the Russian ruble would deserve a talk for itself alone because it might be influenced by what's going on now in the geopolitical landscape. And what do I mean by that? It's going to be even clearer when we are looking at oil. So let's have a look at oil. Crazy oil market, right? You remember what I always say. Yeah, look, commodities, especially those critical commodities like those tied to energy, in this case oil. Yeah, I mean, you can have all your TA set up and then it just takes an announcement or something to completely blow your TA out of the water. But it is not an excuse, right? So let's try to analyze this one with a little bit of a critical thinking, right? So we were looking at these lows as an area, right? And, the main premise was, look, although you might keep on retaining a midterm bearish bias on this one, just pay attention. This is kind of, and just mind you, we were in here, right? The market last Friday just closed here, right? But, we said, tame your horses if you are on the bearish wagon in this case, because from this area in the past, we have seen sharp bounces. Now, we discussed about a really good potential setup for a long, which was including a swing failure pattern of these lows, which didn't happen. So that setup, no pun intended, but it didn't set up, right? Didn't unfold itself. So at the end of the day, right, you might be prepared for a scenario, but if it doesn't play out, it doesn't play out, right? Same as, we were stalking some sort of a potential short opportunity at this previous level, which was anticipated support, broken, then possibly resistance, in order to, I don't know, maybe selling in here and targeting the lows, right? And that, if you play that, it just failed, all right? Now, all right, but why did it fail, right? Because on the 22nd of October, I think, if my memory is serving me correctly, we got major announcement coming off of the US and basically all the Western bloc, so the UK and the EU included, which was new sanctions on Russian oil. Now, you might say, well, I mean, it's nothing new. We have seen it in the past, and at the end of the day, it didn't result in a major catastrophe for the oil market or for Russia, for what matters. No, actually, I mean, I live in Europe, and I would say that all these sanctions that we have put on Russia, at the end of the day, actually hurt us more than them, I think. At least, when I talk to people and when I look at the energy costs and the energy bills, but that's a different topic. Don't want to get political, at least today, right? I done it in the past, just a tiny bit, but not this morning. So look, I think the different one, I mean, the different factor this time around, it was that we've seen at least, manifested intentions. Then we could discuss about backdoors and black markets and shadow fleet and all the rest. But we have seen two major players, China and India, which, by the way, are the two most, valuable, the two biggest oil buyers, Russian oil buyers. They announced at least that they would stop buying Russian oil. So now that could be really impactful on Russia, I think. But if you look at it through the lenses of the oil market, you might go and say, okay, so what? I mean, if those countries, at least, that's what they say. We don't know if they're going to push through with the facts, but that's what they said for now. If they're not going to purchase Russian oil, I mean, they still need oil. They're going to purchase it somewhere else. So that demand will shift from the Russian side of the market to the rest of the world part of the market. So that should bring in a new buyer. And I think that's why the futures move like this impulsively to the upside. Just, trying to move in a forward-looking manner to kind of anticipate potential new demand coming in for oil globally, right? Will it last? I don't really know. Like, I tend, at first glance, at the very least, we'll see in the next few days or weeks, but at first glance, I would say when you got some sharp price movement in oil, which is driven by these announcements, usually it doesn't last a lot. Like the most recent example that we got, it was the bombing of Iranian nuclear facilities, right, back in June. Yeah, oil spiked, and in this case it spiked like a lot, because of course if we have conflict a huge conflict in the Middle East, it's going to impair the ability to move oil around, and it could create some sort of a supply constriction, right? And then what? Then, the US weren't really involved in a long conflict. The conflict didn't enlarge to the entire region, and so oil came back down. So I would say in this case, don't discard the possibility that maybe in the coming weeks, a few of these sanctions might actually be, I don't want to say lift, but maybe remodulated, all right? Or maybe Russians, they find a way around it, as they did in the past. Or again, maybe China and India are telling you as if you were the Western bloc, right? Okay, we are going to play ball, we're not going to do it. But, under the table, they're still doing it, right? They're finding schemes and other ways to make oil able to actually get into those countries, although they're not making it so visible and so evident. So we'll see about that. I think, technically, it just got back into previous resistance, right? So for now, in the very short term, I would say just, shift to neutral, maybe, right? We reclaimed this level right here, but so far, we found resistance at the previous relevant level, support, broken, retested, flipped as resistance, down we go. Come back into it, so it should be anticipated resistance up until the point it's not anymore. So take these overall range up here and take these reaccumulation pattern right here, so this fractal to the downside. And let's say that you might shift to neutral up until the point price gets above this level right here, right? Or gets back below this level right here. And then we'll see what's going to happen. But for now, in the very short term, and for the first time over a longer enough period of time, I say I'm not as bearish as I was before. I might say I'm a bit more neutral in the very short term. I'm just waiting for new price information, right? Although, if you ask me about the long term, still, I don't really see many reasons for oil to be massively up. If not, what we hinted at last week with Scott Bessent saying that they could implement price floors for some particularly crucial commodities. And of course, he was absolutely talking about oil in the first place. Could be something else, maybe, but I think for the most part, it was referring to oil, right? So let's have a look at Bitcoin. Quite honestly, it's kind of like last week. I don't really know what to make of it. It's still choppy, right? And even those two levels that I highlighted last week, I mean, they didn't really play a lot. Like you might say on a closing base, the first one offered the initial rejection. Yeah, I mean, maybe, but come on, price just broke through it like a lot before finally being rejected. So did it really work out? I wouldn't say so, right? And, right now we've seen another rejection, but still higher low, and we are trying to push back. So I would treat it for what it is. It's a market which is currently going sideways. I think, after all the liquidations and all the volatility, it needs to get back into balance just a little bit. And then we'll see. Like, honestly, I don't really have a lot to say about Bitcoin. If you would really point a gun to my head, I would say, well, I mean, look, it's a risk on asset, and I've seen the equity market just made new highs for the week on a Friday. So maybe by extension, I should be a bit more bullish tilted on Bitcoin just for, the correlation in between Bitcoin and other risk on assets. But I mean, other than that, it's just, I don't have a very defined opinion on this one. If not, then of course, it would be, the riskier one among the risk on assets. So if you see some sort of a decline in other risk on assets, probably Bitcoin and crypto should decline more. Although, again, the counter argument would be, yeah, well, but we have just witnessed the biggest liquidation in the history of the crypto market. So is it, right? Is it that we could have another sharp drop? There are not enough people over leveraged long to be liquidated sharply. Maybe, I guess, both arguments are good arguments, and which is why I can't make up my mind, and I'll just wait and see. Again, another cliche, right, that I always repeat. Sometimes it's fine not having an opinion, and sometimes it's fine not having a position. If you don't have a strong opinion, obviously you don't have a position. I mean, unless you're brain dead, but but that would be another topic. So let's have a look at gold instead. Now, gold was really interesting. So let's have a look first at what's going on currently, right? And then we'll zoom in, because there's one thing that we could discuss just to see or to recap how the assessment we had last weekend actually played out, right? On the higher time frame, it looks like we got a bounce on a Monday, and then on Tuesday, we smashed through. I mean, it was a really considerable dump. It was carried on into Wednesday. But again, if you look, where did it get, right? Right, that lower shelf that we were looking at on a higher time frame base. And I just added a set of moving averages just for the sake of it, as I do with indices on a larger time frame, right? So basically, we broke the. I never remember. Is this the 8 or is it the 9? Should be the 8. But I mean, let's just quickly check out. Yeah, it's the 8. All right. So it broke the 8 exponential moving average, and the following day it came back down into the 21 exponential moving average on a daily time frame. And from there, we tried to put together a bounce. Now, the bounce, which was, in my view, validated both from the shelf below and the exponential moving average, was stuck when? I mean, it was faded when, or found resistance where, right? However you want to spell it. Well, the previously broken moving average, right in here, right? The 8. So again, we are kind of stuck, right? In this region for now, in between the 8 now providing resistance to the upside and the 21 providing support. Now, if you check, it is clear enough just looking at the candles, but if you check, it looks like this range now where price is stuck, it's contracting slowly. So at a point, it's going to have to break one way or the other. It could break to the downside, so you'd see the shelf giving out, and the blue may be crossing below the 21, the yellow. Or it could keep on bouncing, reclaiming the blue, in this case, and the yellow would do its job providing support. It's just like, since these rallies started, we never really retested the 21 for real. We always walked to the upside using the blue, the 8 moving average as support. So this should be the first retest of a much more intermediate term moving average. Although, the 21, it's not that mid-term. It's still, I still see it like a short-term moving average, right? It's not like your 50 or your 100 days or whatever you. But yeah, so I'd say again, up until the point it doesn't break out, I would go with the trend. So I would say, look, it's still a bull market, right? We might have had a little bit of a drop, all right? Yeah, it was extended. Sentiment was going a little bit ahead of itself and all the rest, as we discussed last week. But at the end of the day, this is a buying opportunity up until the point it's not. So, you could buy this one, and then if it cracks it, you know that it's no longer valid, and you can get out of the market with at the end of the day, it would be a tiny stop, like what, 2-3% loss at the very, at the very top, right? Because then if we crack this area, we might get back toward the 55 exponential, or at least this tiny little region right here as an intermediate type of a bouncy area. Because supposedly this moving average on Monday, when the market opens back up, it should climb to the upside. So you would have another set of confluences there. But at least you know that you don't want to be a buyer in here anymore. Now, let's zoom in, right? And let's get rid of these moving averages for now, because they would clog the chart. So look, if you remember last week, right, when the market was closed, we were highlighting these two levels right here as potential level of resistance, right? The market, mind you, it was here, more or less, right? Now, on Monday, we immediately pushed to the upside. We broke the first one. We broke the second one. We tried, so we retested the area overall, and then we pushed for new highs. All right, so now at this point, as I said, if the market is really bullish, if it's showing you a willingness to go up, at this point, momentum should remain, and you would see the market keep on pushing for new highs. Didn't really happen, right? The move was faded kind of quickly. It started in Asia, and then it accelerated dramatically at the European Open. So again, if you see this level, or these two levels, as potential triggers for immediate bullish action, well, by the same token, if those levels are quickly lost again, or the move is faded, what does it tell you? Well, it tells you that, as we said, there's not enough liquidity below here, because we've seen this last pocket was picked up before the run up. The drop actually cleared out all the remaining liquidity at these levels. These actions suggested that, yeah, it would it was particularly wishy-washy. So maybe a lot of liquidity in this region right here was already picked up. So there is not a lot holding it up. Maybe a little bit of a short-term bounce potential in here, but overall, if you look out on a higher time frame, the real target would be this one, the daily shelf to the downside. And you know, it just took what? A day and something to get back into it. So again, I mean, it was, I'm just going to show you that because on one side, right, conceptually, you might say, okay, the setup failed. Because yeah, we've seen what we wanted to see to be bullish, but it lasted just for so long and it was immediately invalidated. Yeah, but that's the point. Look, if you see something that you deem as bullish in this case, and you say, I'm going to stay bullish up until this plays out. If it stops playing out, then you know you can't be bullish anymore. As a disclaimer, I actually sold a bunch of gold when the market came back down. Again, when the market lost this level right here again, at and around 4,300, I just sold a bunch of gold. So again, that was the thing. Now you might say, you didn't sell at the top. Okay, I didn't sell at the top, but you know, I sold in here, this region basically. So what was that? A 2% drawdown overall. And then the market kept on going for what? 8.5. I mean, again, I'm more than fine if I can avoid the remaining 6.5% of the drawdown. And actually what I did, although I think I might burn myself this time around, but I did it. I actually had to do it, right? It's not going to hurt me a lot considering how gold performed and how well it performed, but I actually bought. So I sold in here, I bought back into here. We'll see next week. But, you know, that shelf right there with that 21 moving average for me, it was just too good for at least not trying to put together a few limits there. I bought kind of like spot prices are a bit different, but you know, I scattered a few limits for a buy order in between 4,050, 4,040, 4,030. So a few of them, a good chunk of them were actually filled, and you know, we'll see about that. Now the premise was that we had a very inefficient delivery to the downside. So at the very least, all right, if I lose it, like what am I losing? Because let's bring back the moving average for a minute. Right, I buy overall in this region right here, right? So if the market goes down, what am I losing? 2% or something. If the market goes up, at least feeling the inefficient move down on a Monday, what do I get? 3.7, almost 4. So it's already a 1 to 2 risk reward, which for me, you know, considering I am with the overall trend on a daily time frame, yeah, I'm gonna play it. Maybe it's not gonna work. Who cares, right? You can't be angry if sometimes it doesn't work. So maybe we wake up Monday morning, European time, I see this market in Asia already plunging, and I'll say, well, fuck it. I gave it a go. Didn't work. That's just, you know, that's just the game. But, you know, I'm pretty confident that, you know, I'm not yet confident that it's going to play out, but I'm confident that it was a good setup with a good risk reward just to get back to the first trouble area, right? Let alone another test of the highs. So we'll see, right? Now, we are going to set aside all the talks about the debasement trade, like gold is being defined. I should probably record a separate part or a separate video for that. We'll see. But, you know, for now, I'll just keep it. We'll see how long this video will turn out to be, right? So let's move on to yields. Now, yields, after the sharp drop, which basically begun in the mid part of October, so in the middle of October, we made new lows, all right? And again, now we are just going sideways a little bit. But, you see what they do, right? Every time after a sharp drop, you have your period of consolidation and a little bit of a drawback, and then potentially, again, another leg down. So wouldn't be surprised if you see, let's say, the 10-year getting back to, 4.1. Last time it was 4.2, and that kind of played like a charm. So we'll see if it keeps on going the way it's going. Like, again, it's another one of those things, right? The trend is the trend, and the trend is down for now. If you zoom out, okay, you might say, yeah, the trend is down, but overall, we are still in a sideways market. Yeah, I would agree with that. Although, again, fundamentally, I think that there is not a lot of reason for yields to keep on going higher. Again, this is another thing which would really go hand in hand with the debasement trade, but it's kind of too good for not talking about it. But all right, let's hold on a few more minutes, and then we'll see. Conversely, treasuries, of course, they dropped a little bit, and I mean, really nothing crazy about them. They have dropped in the past, like in here, so they're still making higher highs in this current junction of the market. So yeah, again, if you think rates will be lower, you would expect bonds to be higher. Although maybe, as a counter argument, we should always remember that the market tends to price in things ahead of time. So don't discard the fact that when the next cut will be actually announced, you could have some sort of a sell the news event. So, we'll see about that. But for now, again, yields down, bonds conversely should be up, right? So that would be, as usual, for the first part of the chart. So let's have a brief pause, and then we will discuss the equity market. So stocks had a good week overall. As you can see, there was a lot of green on the chart. We had, as anticipated, a few earnings report. So we had, I think, if we can get back to it, what we got. We had, waiting for it to load up, we got Netflix, we got Tesla, and we got Intel. Now, Netflix, let me check real quick. Was some sort of a miss. I mean, the background, it's red, so I would expect some sort of a miss, which, revenues came in line with expectations, so I guess they talk of it as a miss because it didn't beat, but earnings per share, yeah, that was a miss, to be honest. Tesla, what was about Tesla? That was a bit, so revenues was a bit, earnings per share, in line. So why, if it comes in line, it's green, but if it comes in line on the other side with Netflix, is red? Because the market needs to be bullish every single time, right? And Intel, what about Intel? Revenues, all right, it was a bit. Earning per share, wow, that was a good bit. So yeah, that was it for the earnings. So I think, overall, let's have a look at the chart and let's see how they moved throughout the week. So Friday was a little bit of a dumpy day, but just getting into the close, the market was already climbing back up. Then we got the open on Monday, and lo and behold, we keep on pushing to the upside. So, just kind of a good start for the week, I guess. We then had a bit of sideways on Tuesday. The market was particularly choppy. Another drop to the downside on a Wednesday, and then we got our lovely Thursday reversal, which kept on pushing into Friday, and we went for new all-time highs. Now, what's really cool about it, it's this one. Now, I switched to regular trading hours, so standard versus extended hours. And what you see is that on a Friday, when the US markets actually opened up, we gapped up to new all-time highs. Now, basically all of them, if not as usual. No, the poor Russell, which is constantly underperforming all the rest, but I don't know, people still likes it. I'm not judging it. To each his own, I guess, but yeah, not for me. So that should be massively bullish, right? What's more bullish than gapping up to new all-time highs? Not only the market gap to the upside, but just happened that upside was new all-time highs. So all cool, I guess. I don't think there's like a lot to say about equities. It's a bull market, right? And it will go on up until the point it will go on. Yeah, there are all the risks that you can think of, and all these narratives going around, especially about the AI bubble and all the rest. Now, quite honestly, my personal opinion is that, yeah, as I said, I think we are in a bubble, right? But the point would be trying to assess if we are, let's drive another parallel. Are we in 1997 or are we in 2000? Because, yeah, we were in a bubble at both times, but in 1997, we kept on rallying hard for another 3 years. In the 2000, we just crashed. So I guess even trying to assess that component could be beneficial. If not, at a point, it will be crucial. But for now, again, in the very short term, as we look at things week by week, all seems to be cool. Now, if you switch to the other layout we look at, and we are back again to extended trading hours, as you can see in here, yeah, we made new highs on a closing base, right? That's cool. But if you look at the RSI, if you look at the stochastic, and if you look at the MACD, the RSI, it's still on the go to potentially not, it's not there yet. So just be cool. It's not there, right? But potentially to create another bearish divergence in the coming week. But in order to do that, it will take the next candle to trade below the lows of this one, or potentially even better, closing below it, right? So confirming another local top, which again, we don't have the data yet, so we can't say that. Just be on the high watch. The stochastic, it's getting back to test the bullish zone in here. And potentially it could make a lower high compared to the previous reads, but overall the market started to go a bit choppy in this region, so I wouldn't read that much into the stochastic at this current juncture. But again, the MACD is still having a sell signal, or at least it has it on ES futures. I think it's trying to, it actually deleted that on NQ. So if you're bullish, it's not bad having NQ confirming the bullish posture ahead of ES. So, NQ should be the leader, dragging the rest of the market up because of the current market structure and how, the market capitalization, the allocation, the passive investing, and all the giant mindless robot and all the rest. So by those logics, it's natural to see NQ a bit stronger. But I would wait a little bit to have the histogram confirming it. But I mean, at the end of the day, if you remember, two weeks ago when we had this sharp drop, right, we were looking at the relationship in between the light blue moving average or cyan moving average, I don't know, which again, it's the 8 exponential, and the relationship it got with the 21 exponential in green. And all we said was, wait, up until the point the faster one crosses to the downside relative to, the 21 in this case, it's hard to be bearish this market, because we've seen in the past the market can be choppy at times, but up until the point that signal is not given, don't be hyper bearish, right? And once again, this simple tool, which is at the end of the day, it's just a moving average, right? It's nothing more than that. But it kept you with the right bias to have. So we dipped below these two. We kind of found support back at the 55 in green. We chopped around for a week. Then, just on Monday, we broke to the upside above the 8. We spent like Wednesday and Thursday retesting both the 8 and the 21. They were confirmed as support, and up we go for new all-time highs. So there's really not a lot to say. It just did what it was supposed to do at the end of the day. So do you wanna, as usual, looking at some doom and gloom stuff just for the sake of it? I mean, we could, I guess. We got war. I mean, I think this is not that doom and gloom. Actually, this would be kind of encouraging if you look at the consolidated positioning, right? Because, we are not that, overexposed at this point. It means that there is still time, or there is still room or space for new buyers to come in, right? It would have been different if we were at new all-time highs and we were getting some sort of reads like these, or potentially these, right? At that point, you might say, oh, well, okay, we are overextended, or all the potential buyers already bought, so we'll see about that. But for now, at least we are coming off of a neutral region, so that's good for the bulls, I think, right? If we look at discretionary against systematic, the systematic strategy, so I would assume CTAs, are still particularly long, not at critical levels, but still on the long side nonetheless. As for discretionary investors, it looks like, are they underexposed, like 20%? I would deem it at underexposed, no? I mean, it's not like being down here, but overall, again, I would take it as a good sign that there are still buyers available. If I'm reading it correctly, right? Then, though, moving on, what we got, it's still margin depth running high enough. Again, it's not as high as it was in 2021, or 2020 before we started. Actually, what's that? Because it says November 2020 here. Then again, you got January 21. I mean, November, December, of course. And then, we've seen what came in 2022, that very slow and grindy correction to the downside. But we are not looking at something like that. Same as we are not looking at what was the rate in 07, right before 08, and same as it's not the same case that it was in 1999 before the dot-com crash. So again, I mean, are we on the high side of the spectrum here? Yeah, to be fair, but it's not as extreme as it was ahead of major market crash. So not that worrying, at least for now. Although it is true, Statista is telling you that 33% of Americans have more credit card debt than savings. That is not very cool, but I think it plays a little bit in that K-shaped economy we're talking about recently. It was all over the media. I think, it's one of those things that just because it's all over the mainstream media, it doesn't make it less true. I actually do believe we have a K-shaped economy. But so, it might be that this percentage of the population which has more debt than saving, maybe it's the one which is not exposed to assets or to the markets in general, and therefore they are not benefiting from this massive asset appreciation or asset bubble. It could be that too, right? So what else? Just as a reminder, this is some sort of a statistic on what usually happens after new all-time highs are printed on the chart. As you can see, just the next month alone, it's usually kind of good. But, if you look over the mid to long term, like 3 months, 6 months, next year, it's just natural that new all-time highs would be naturally entice the market for even newer all-time highs in the future. It's just, I guess, the bull market keep on going. So another encouraging data, I'd say. Although, where was the doom and gloom? Because I thought there was something when I was putting these slides together. Maybe I've just mistaken myself. I mean, this is another thing which it's interesting. Like we have been discussing about it with the terminology of smart money versus dumb money. So, institutional, like the hedge funds and all the rest, they are kind of net sellers. Like the outflow came in at minus 400 millions, right? While instead, the retail investor added 400 millions. So, I mean, it's something which is going to be evident in hindsight. So, it's just to play the game. But if it turns out that we are going to have a top relatively soon, that would be just the so-called smart money dumping on the dumb money. We'll see. I mean, we're not going to be able to assess it up until the point we actually put in a top. So, this is just for the sake of statistics and narratives, or the chronicles of the market. But for now, I don't know how much weight I would put on it. Like we have been having retail investors buying the dip like for 2-3 years now, and it worked. And actually, at the end of the day, and getting into the end of the year, those which will need to play catch up, well, it will be the ones which are underexposed, because they are kind of, enticed into it because it's some sort of a career risk. Like if the market closes the year printing another 20% gain and you were underexposed equities, well, your clients will gonna get to you saying, hey, the market is up 20%. Why my portfolio is only up 10%? I mean, why am I putting money with you to manage them? At this point, I could just buy an index fund and live with it, right? So, again, I think that there are at least the premises or the basis to see a bit of a catch-up play if the market keeps on, staying bullish from here to November, December, and all the rest, right? But this is something which is a bit controversial. Like I've seen, and it's not the first time, as usual, you see on Twitter, or you got your friend posting you a chart. Oh, what do you think about it? I mean, look, there are so much money on the sidelines in money market funds and all the rest. I have already disputed this thesis in the past. I don't remember how long ago, but there were a few slides, a few charts, which actually really threw a dent into this logic that just because money are getting out of money market funds, they would mathematically go into risk on assets. You just don't know, right? Again, just briefly, if it was, if it is a bull market, right? It might be that you will see money market funds being depleted because people will try to get back to chase the higher returns in the stock market. But what if money are getting out of money market funds, but the market is bearish, the economy is going down the drain? Are you still sure those money will chase risk on assets? Or they're going to chase safety, liquidity, and security, like bonds, treasuries, trying to lock in those higher rates they're now getting in money market funds, but locking them in for another 2, 3, 4, 5, 10 years? I mean, you don't know. Plus, you should have, if money market funds are yielding you less, it's because yields are plummeting. If yields are plummeting, conversely, bonds are going up. So not only you are locking in those rates, but you're also in an asset class which should appreciate in value in that period. So I think it's just a false assumption. It's not really a mathematical correspondence. It doesn't mean that because they come out of money market funds, money will mathematically move and rotate into risk on assets. They could. I'm not saying they couldn't. I'm just saying it's not a mathematical certainty, right? So just bear in mind when you see those narratives going around. Now, this chart alone, it doesn't tell you really about money market funds, but I thought it was interesting to get back on the topic because we are still talking about the same thing, just money on the sideline, right? In this case, though, we are analyzing fund managers. So this should be some sort of a survey that Bank of America runs. Fund manager survey, right? So they're answering they don't have a lot of money or cash on the sideline. Now, again, why it might be, I don't know. Maybe they allocated those per money into gold or into bonds to kind of have a little bit of a diversified portfolio, or mitigating the risk on assets going parabolic to the upside, right? And so then when the next sharp pullback may come, gold and maybe treasuries, they should provide a little bit of an edge to the portfolio overall. I mean, maybe, could be. The fact is that they don't have a lot of money on the sideline. And you might say, but how is that possible? I mean, if we just saw that they are underexposed, the equity market. Again, they might have those money somewhere else, right? So could even be international, right? I mean, have you seen how something like what was that? The Hong Kong index performed? It had a pretty relevant bounce. Now we'll see if it's gonna keep on going, but even emerging markets, they're not performing that badly, right? Or at least they didn't perform that badly recently. So maybe they got money depleted somewhere else, not necessarily waiting to be deployed in the US equity market. I guess we'll see. I'm just trying to say that be careful with your assumptions, because it might turn out that they're not really solid as you think, or as Twitter would like you to think, right? Still a bit of speculation. The number of leveraged equity ETFs which are being released, it's hitting record highs. Last week we were looking at the fact that we are moving from 3x ETFs to now 5x ETFs, because why not, right? Why wouldn't you put on more leverage and more risk when the market is so cool to be in, right? But has it ever ended well? So, I guess, again, we'll see about it. It could be another 2 years down the road, but at a point, all of these exuberance, it's going to explode in a very dramatic fashion, I think. Not tomorrow, not next week, probably not even next month or next quarter, but, at a point, it's just gravity. It's going to take over, no matter what you think, right? And finally, the seasonality, we were looking at it, and the seasonality was defeated as a statistic in August and September, and so far it looks like October it's playing out as expected, and we'll see what's gonna come getting into the end of the month. I think we are expecting a bunch of inflows in equities for October especially. But, we'll see. Seasonally adjusted, as you can see. The seasonal composite, when it comes down to flow of funds, it should tell you that we might see money being poured in, right? Especially because we are now kind of in the middle of earnings season. And when that's going to end up, we are going to have the buyback window open back up again. And as you can see, the mass buybacks are coming back. So you see what has been authorized so far. And just remind that usually the majority, like 25% of the entire chunk of buybacks for the year are actually performed in the last quarter. So, again, here comes again your dynamic of the Santa rally and all the rest. Right now, we'll see if it's going to happen. Just remember, although, there might be a mix of good news, bad news, but it doesn't change the fact that overall, over a long enough period of time, the market is particularly extended. All right. But again, at the same time, you should remember that, We are extended, skyrocketing valuations and all the rest. AI bubble, sure. All you want. I'm with you on that side. I think the market is particularly risky, and I think the equity risk premium that you get, it's it should entice at the very least a bit of caution, right? Now we've seen volatility picking up a bit, so it might be the market overall it keeps on going to the upside, but don't discard sharp pullbacks as we have seen just 2 weeks ago. Okay, when the market on a wide enough time frame like this gets so extended and so deviated from long-term averages, as you can see, it might be that at a point something cracks, you just get that catalyst that you needed, and the market just mean revert to what should be the long-term mean, obviously. All right. So, I mean, it's like we we need to keep on dancing up until the music is playing, but at a point there should be someone which is, it will just keep on dancing, but probably stepping closer and closer to the door just in case to be ready to jump out of the room and stop dancing. So we'll see about that. So that should conclude the parentheses on stocks and on charts overall, right? All right. So I thought I didn't want to do that, but at a point I thought, you know what, especially while I was recording, just for the sake of completeness, and because if I keep on procrastinate, I'm never going to tell this one. So look, just another 15 minutes I'm going to steal of you because, at a point, if you are here, you got nothing better to do. But let's talk about this debasement trade, right? So everyone is looking at these charts, so the DXY, but most importantly, and maybe more closely, people are looking at this one, the gold chart, skyrocketing, right? And the mainstream narrative is gold, it's sending the signal that the age of the US as the global hegemon, the global reserve currency, it ended. And it's time to change. As usual in history, nothing lasts forever. And the way the US empire, quote unquote, it's going to end, it's how all the empires of the past actually ended, by debasement of the money, which again, I'm not totally discarding that. Like at a point, everything will end. Life itself will end at a point. So I'm not arguing against it. But I thought it was just beneficial and potentially useful to give a little bit of a counter thesis to it, just so that then you can make up your mind and see which one of the two theses actually stick with you, right? So let's have a look at this. Now, when we talk about debasement, it's mainly because the mainstream media starting in August went nuts with these charts or with these type of charts. So basically foreign central banks actually having now more gold reserves than US treasuries, right? So it looks like globally there is a shift in deeming as the more pristine reserve that you could have, rather US treasuries or gold. And it looks like gold for now, it's flipping treasuries, right? And so people say, see that? Because of the debasement of the currency, because of all the fiscal irresponsibility, the fiscal deficit and all the rest, the world is losing trust in the US currency and, the US as a whole, right? Now, okay, I get the point, although let's first of all discuss the terms. And again, it might seem like semantic, but it's really not once you understand a little bit the dynamics at play, right? Because I already hear the objections, yeah, but this is just semantic at a point, it doesn't matter how you call it, but the effects are on the average Joe, the consumer, the citizen, it's going to be the same. Well, maybe yes, maybe not. So let's just try to look into it. And then again, if you want to keep on thinking the same, you're free to do it. I'm not here to necessarily change your opinion, but just to offer a different view. So let's move on. Now, what is debasement, right? In and of itself. Well, look, we have seen in history, getting back to the ancient Greeks and Romans, that you can actually debase a currency, right? They used, especially in Rome, they used to change the structure of the currency, right? By reducing the amount, in the Roman case, of silver in minting coins. So, it was easy to print more or to coin more silver coins and be able to repay the debt like that. But the amount of silver actually present in the coin was less and less and less. So that's your debasement. Now, first controversial point. Can you debase fiat currencies or fiat money? Depends how you want to call it. Well, I mean, think about a dollar bill. If you cut away a corner of it, is it really not usable anymore? Or it doesn't buy you the same amount of nominal value which is stated onto it? I think no. I mean, up until the point you cut it in half, but if it's just a bit trashed, right, it's going to be accepted, right? So I think, materially, you can't debase fiat money because fiat money, it's just an arbitrary measure, right? We say $1 is $1. We say €1 is €1. We say €1 it's €1 by decree. So you can't, you're not using less paper to print it, again, quote unquote. But then again, it goes beyond printing because as we will see, there is no money printing, right? So the government and the Fed, they're not printing. Someone else is printing, but it's not those two, right? But let's move on. So what we've seen is that even in, if you check the trends for these terms, debasement just skyrocketed, right? For good reasons. Again, gold is actually sending a signal and all the rest. But in order to actually have debasement, what you need to have is, an excessive increase in the money supply, right? And you would need to have declining purchasing power. All right, that's true. And you would need to have a loss of confidence in the currency or in the system which is actually backing up the currency. So the question might be, are we seeing all those phenomena play out at the same time? Because if we are not, can we really talk about debasement? Or is it something else? And I'm gonna give you at least my interpretation of it. The problem for me is that it's not debasement, it is inflation. And here's the tricky part. You might say, yeah, okay, but if my dollar, it's buying today half of what it was buying me 20 years ago, you call it inflation, you call it debasement. The simple reality is that my purchasing power is going down. All right, if you look at that in isolation, I would agree with you, right? But let's just think about the three cardinal points for actual currency debasement, in this case, dollar debasement. Let's have a look, for instance, at the money supply, right? So we know money supply can go up, can go down. We usually look at M2, which is a flawed measure anyway, but it's accepted as a standard. And, M2, therefore money supply, it's not impacted directly by the Fed. And what do I mean by it is that, it's not the Fed printing money, the money are lent out into existence. And that's a huge difference, right? Because if I really print money and I put them into the economy, and therefore I increase the money supply, and those money won't be able to disappear. Therefore, I'm going to generate inflation for sure. If I lend money, they can circulate into the economy, right? But at a point, those money will need to be paid down. Because if they're lent out, I'm creating a debt. And at a point, I will need to pay down that debt. It doesn't matter if I'm a government, if I'm a company, if I'm an individual, right? Those money kind of have a lot of expiration date onto it. And when money and debt, in this case, gets paid down, you have money destruction. And same goes if you default on a loan, right? That's money destruction. So conceptually, it's different than printing. Printing assumes that those money will stay there for eternity. Lending new money out into existence assume that at a point, those money will be, needed to be paid down. So that's already a good distinction in my view. Secondly, the Fed, it's not really impacting the amount of money in circulation unless, as we've seen, we are helicoptering money to the public, right? Which doesn't happen very often, by the way. Now, who then is really creating money? Well, it's the commercial banking system, right? It's your Wells Fargo, it's your Citibank, it's your JP Morgan, or whoever, right? The Fed, on the other side, can incentivize or disincentivize the creation of new money, so the extension of new credit. And how does it do it? Well, by moving, or at least they think they can do it, by moving Fed funds all around. So have a look at this. Now, first of all, just to close in on gold, yeah, there has been a huge demand for gold, mainly coming from, look at that, investment, and, to a smaller degree, central banks, right? And if we look at technology or jewelry, those two are actually going down. But even if you zoom in, it looks to me that the majority of this candle right here is composed by the blue color, so investment. That is just a hint of what it will be, the final end, right? Now, so it's true, purchasing power of the US dollar is going down. So this is the argument for debasement of the currency, right? But if it is so, then why are we looking at the US dollar still representing almost 60% of, reserve currencies, right? In the basket of all the currencies which other central banks or other countries use as a reserve, the US dollar is still 60% of that. So if it is debased so much, why people should keep on holding it as reserve, right? Then again, that doesn't tell you a lot about the relationship with gold, but we are going to get to it toward the end of the explanation, all right? Then, if the dollar is so critically debased, why we are looking at a situation where over the last almost 20 years now, the broad dollar index actually came up? Shouldn't it go down if one of the three major points of the debasement, it's a loss of faith and trust in a currency? Why is it going up against all the others? Now you might say, well, maybe the others are debased as well, but they are debased even more than the dollar. I guess you could be right in a sense, right? But still, I don't see a lot of signs of debasement in this chart alone. And, over a long enough period of time, what you see is that basically the dollar always oscillates in between this value, this mean, which is natural because that's how governments use their currency. They're just a tool to balance out global trades, right? So, yeah, currencies can deviate from the means, right? But one way or the other, there is always going to be an incentive on the government side to get them back to an equilibrium point. Also, they can vary or they can move around depending on what other countries are doing, right? So if you think about the relationship in, the United States and China, right? Major trading partners. If the Chinese are moving their currency one way, probably the US will do the same to balance out trade. Or if the dollar is appreciating, maybe you could see Beijing reacting in another way to manage their own currency, right? So again, it's not simply the debasement argument here. But, are we printing more money, again, quote unquote, or is the Fed, since we already established that the Fed, it's not printing, but it's lending or incentivizing and disincentivizing the credit extension, are we creating, therefore, more credit, therefore more money, or are we creating less money? Now, if you look at Fed funds for now, relative to real GDP, so adjusted for inflation, and CPI alone, it looks like Fed funds is higher than CPI, it's higher than real GDP. So the Fed, it's really not incentivizing the creation of new money or the extension of new credit, all right? And even if you want to tackle the topic from, the standpoint of the fiscal deficit. So yeah, is the government borrowing more and more money? Yeah, they are. But think about that. On one side, you could argue that a massive fiscal deficit, it should be concerning from a money supply perspective. Although, consider also the other side of the coin. Banks have limited reserves, aka limited resources, right? So if they are forced, right, and they can be, by the way, forced to buy the debt, the government debt, well, that just means that they will have less resources to allocate to actually lend money out into the real economy. And again, commercial banks, those are the ones which are actually creating the money, right? Because when they lend something out, if you take a mortgage, right, those money didn't exist before. You go to the bank, you ask for a loan, they just take the balance sheet. On your side, they put, a debt toward them. So for you, is a liability. And on that side of the balance sheet, they put an asset, which is the loan itself, which just states that they have a credit toward you. So you just created a liability and an asset, and you got a bunch of money. Poof, out of thin air. But again, it's not printed because you created the liability and you also created the corresponding asset. If the liability goes away, aka, I don't know, the debt is defaulted upon, so goes the asset. And those money, poof, just go to money heaven, right? So if you think the Fed is not really encouraging new money creation by extension of credit, you should also look at these. If you look at M2 and the economy, right? So you got your M2 money supply, you got your GDP, both expressed in billions, and then you look at the relationship in between the two, it looks like money supply and GDP are basically growing up in locksteps, or they are very highly correlated. Because what? Because the more an economy grows, or the more a population grows, the more wages grow, you're going to need more money for it, right? So you can't have sustained growth, economic growth, if you don't have a corresponding expansion of the money supply, all right? Again, you might say, getting back to the beginning of the semantic argument, you might say, yeah, it's not debasement, but it is inflation. Sure, but you actually need inflation if you want to have an economy which is growing in the current system as it is set up. And I didn't make the rules, right? I wasn't even alive when they established this new system, so it's not my fault. Don't shoot the messenger, right? Now, look, even at the peak of M2 growth, right, throughout the COVID pandemic, the money supply growth never actually exceeded 100% of the relationship with GDP. Because sure, we have an obscene amount of money injected into the system, but at the same time, we had an obscene amount of growth, which was, completely off the charts for the US, an economy which, under normal conditions in recent years, should grow from 2 to 3%, 3% if it is a good year, right? So again, there is still this relationship. The economy grows, therefore money supply grows. It's just some sort of a symbiosis. They are tied to the hip, so to speak. And look, there is just one period, maybe two, but just let's stick to the recent one, when you see M2 actually growing than GDP. And it was right at the beginning of the pandemic. And what did you have as a result of that period? A spike in inflation. Because you can't have inflation up until the point those two are moving together. Or at least, you have that sweet spot rate of change in inflation where, yeah, inflation goes up, but so goes GDP. The problem arises when you have M2 growing really faster than GDP. Right? Because if GDP is growing, so are your wage, right? So are your disposable income and all the rest. So are your assets. So if you got a house, if you got a portfolio, whatever, so you're getting wealthier in a sense. And again, you might say, okay, and so how did we come to the K-shaped economy? Well, I mean, again, it's because maybe some people didn't understand the difference in between holding a currency in their banking account and maybe investing those money into something. And it doesn't have the stock market necessarily. It could be real estate, right? Could be precious metal, could be whatever. But just, for a long time in the history of mankind, everyone understood the point of actually making their money working for themselves instead of watching them staying there idling, right? It's a poor use of resources, right? It's really a poor use of resources, right? Now, here, another type of evidence. Sure, money supply grew, inflation went up, right? The dollar purchasing power, like it's buying you now a fraction of what it used to buy you. But at the same time, look at real disposable income, right? And remember, it's real. So it is adjusted for inflation, right? And again, if we check another metric, which could be this one right here, like if you look at over a long enough period of time, 3 months T-bills returns versus CPI, like, I mean, it's moderate as an overperformance, but still, there is, on the other side, there is no clear evidence, right, that purchasing power has been depleted, if at least you were keeping your money with 3-month T-bills. So again, it's kind of, it's kind of defeat a lot of narratives that you see going around these days. So for now, we have highlighted the, among the 3 points we discussed in the beginning, we have been looking at the excessive increase in the money supply and a declining purchasing power, right? But let's move along. So about the loss of faith and trust into the currency. If the dollar is so debased at this point, no one trusts it anymore, then again, why foreign holdings of US debt, it's our all-time highs, right? Who would want to buy treasuries if the dollar is so fucking debased? No one would say. So these charts should be plummeting. Instead, it's keep on rising. Why? Right? So here's what could be the kicker. When you think back to the chart, to the pic, the first picture in the beginning, gold reserves flipping US treasuries, look at this. What, that is expressed in monetary terms, right? So what is the real reason? Is it because central banks bought a lot of gold? I mean, they bought. Why not? Yeah, sure they bought. But at the same time, gold over the last 5 years went from what? 1,700 up to 4,400. So is it, when you look at gold as a percentage of total FX reserves, is it because they really stockpiled on gold, or is it just because gold prices went to the moon? And at the same time, if you think about the other argument, just for instance, if they were using long-term US treasuries, at the same time, the price of those treasuries plummeted, right? So is it really about, supply or actual quantity of gold, or it is also because, whether you like it or not, prices actually matters, especially when you measure things in percentage terms, but those are based on monetary and nominal values, right? So again, I would say, is it really about debasement, these gold run, this gold rush, this gold fever? Is it really all about debasement? And again, I'm not saying debasement isn't real. I'm not saying that the money or the currency is not losing purchasing power. I'm just saying maybe it is happening for some part of the population. And again, I'm not going to shit on anyone, but instead of staying on TikTok talking about shit every single day, especially the younger generation, maybe they should think about what type of system they do live in, right? But just a parenthesis, again, all due respect, but shit, come on. But again, I think, I mean, there will always be poor people, there will always be rich people, but overall, on aggregate, as we've seen for the personal disposable income, as we've seen for, just think about the amount of wealth and the standard of living. Over the last 50, 60, 70 years, is the standard of living higher or lower? I think it's higher. And although you pay more for what you buy, if you could just discard the last 3, 4 years, right? Because of the pandemic distortions and all the rest, overall, on net balance, the standard of living is higher, wages are higher than before, population grew, so therefore you need to have more currencies in order to, address a growing population, because otherwise what will happen? Think about it, what will happen? Population is growing, right? And we don't have enough money. So what you would have is a situation where money would be deflationary because there is too far less of them compared to the new needs of a growing economy and a growing population. If money gets deflationary, you tend to not spend them. If you don't spend them, what's going to happen? GDP is going to plummet. If aggregate demand goes down, so you get into an economic depression. Would you prefer being in economic depression? Although, well, money will be sound. I mean, if you save those money, it's going to be worth more year by year, but at the same time, you're not going to have a job, right? So it's just, again, life is a matter of trade-off. It's just not a matter of simple solutions. I think overall, it's all about playing the game, but playing it smartly, right? And not being misled by all these narratives, right? And finally, why gold did go up so much? Is it because of central banks buying? Is it because of the US empire collapsing? Is it because of the debasement? Or if you check the amount of the value of call options versus put, it looks like even on this one, there is a massive speculation going ahead. So is it really debasement? Or, as it often turns out to be, price movements more often than not are driven by speculation and human action based on war. If you get back to, I don't know, what was the man? He actually died a few years back. Mark Douglas, I think it was. When he was saying, what at the end of the day, why is price moving? What is the move price? Conviction, right? Why do I buy? I buy because I'm so sure that after I bought, the next guy will come in and lift this market even higher. Isn't it kind of the same in gold or in anything else, if you believe so, right? So again, just remember that sometimes narratives are all cool and all the rest, but it's always useful to at least try to dig in a little bit. Right, and this is coming from someone which, as I said it before, was massively long gold. Now, am I long gold because I do believe in all this shit about the debasement? No. Am I long gold because it's going up? Yeah. As much as the next guy, right? And this is why I was, as I described, quick enough to the risk and put risk back on at a much favorable level, because I know these narratives at a point they're gonna stop working. Right? So you don't want to stay there holding the bags when the market crashes back 20-25% and it reverts back to long-term averages, right? And all these narratives are going, as usual, sooner or later, they're going to stop working, right? And again, we'll see over a long enough period of time, but when I see a market going like this, I'm always on the high watch for something quickly and sharply reversing on me. So yeah, why not? I always remember, although you might think to close in on the debasement type of trade, you might think, yeah, it's because of inflation, even if you don't want to call it debasement. All right, let's call it inflation. So that for gold is the all and be all when it comes down to hedge yourself against inflation. Is it really? Because if we look at a long-term chart, I mean, it looks like equities actually worked even better than gold. At times, obviously, they kind of take turn. Like if you look at it in between, let's say, the 1970 and 1980, all right, maybe in this case, gold was performing better. but over a long enough period of time, as you can see, right? Although in this one, we get back to the same type of problem. You need to be able to at least, to some degree, time this type of dynamic right here, because it's absurd to think that, yeah, I mean, I bought gold in the 1900s, and now I can say proudly, at the good age of 120 years, that my stocks actually perform better. Yeah, you're not going to survive the entire time. So, you know, it depends on how old you are when you make the purchase or the bet, and it depends on how these long-term trends play out. So you always need to kind of to time the market on a macro scale, which is not like timing the market by the minute, but you need to time it at least, you know, I think over the next 10 years, right? Something like it. And you need to kind of tie it up to what is your age and therefore your remaining life expectancy. Now, that being said, at this point, really, we can close down the week. I wanted to discuss it because sometimes I like to throw some sort of a curveball because, look, this is something where people continuously disagree with me. And it's fine. I guess that's what makes a market at the end of the day. I'm not afraid of people disagreeing. Same as I'm not afraid of being a contrarian sometimes, and I'm not afraid of being wrong. I mean, people are wrong every single time. I'm wrong every single time. Like, the market always proves me wrong at least 2 or 3 times a day, every single day, because I'm a day trader. So obviously I take losses, right? So being wrong one more time, it's not gonna kill my ego, right? Or my self-esteem. Now with that, I'll leave you off. Have a good weekend, have a good Sunday, and we're gonna check in back on next week. Up until that point, as usual, be nice and be cool. Neil's out.